Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month lead and tin. LME 3-month lead. Last week I spoke about how we'd started to see a move down below the flatlining long moving average, currently at 2080, and the construction of a possible bear channel, currently at 1929 to 2038, which I highlighted in bright green on my daily chart. This week, it is obvious that the market did not have that construction in mind, and prices pushed up and out of the proposed bear channel. Enough that I'll retire this pattern at the end of this commentary. Instead, what we have seen has been a drop in early June, down to the support in dark green, currently at 1972, of the lower trend line of the previously highlighted November 2022 to May 2023 broken descending wedge pattern. The upper trend line is in bright red, currently at 1913. 12 weeks ago I said at the time about this pattern, I quote, "The optimization I have undertaken makes me suspicious about the veracity of this possible pattern, but I'd rather say and only look a fool now than have it confirmed later on," end of quote. Now, I'll expand on this pattern shortly, but the key point is that whilst this broken lower trend line has acted as support in recent days, the previously mentioned overhead long moving average has acted as resistance as recently as yesterday. Thus, whilst it's not certain, it might mean that we are caught between support, admittedly descending support, but support anyway, below, and a flatlining resistance above. I should point out that beyond the long moving averages, we have the declining short medium moving average, currently at 2098, and the medium moving average, currently 2103, both rapidly coming in to reinforce the overhead resistances. Going back now to the descending wedge pattern. This has been a combination of a conundrum, disappointment, and bemusement on my part since March. You see, the market exited out of this optimized descending wedge pattern back in mid-March on the upside and proceeded then to do, well, nothing for a long while. For a long while, we did not have the moves higher for a descending wedge pattern. What we did have is a more or less sideways movement from late March through to the middle of May, with prices capped by layered resistances and sustained by layered supports. On the top side, we have had resistance from the overhead 50% Fibonacci line, the March 2020 to March 2022 move at 2135, the declining medium moving average, and to a lesser extent by the declining short medium moving average. Add to this the recent move below the flatlining long moving average, as well as the Fibonacci and other congestion at 2058 and 2039. The 2039 is the January 2020 high. Likewise, below we still have some layered support at 2021 and 2001. This last one I thought last week was especially strong, and it seems to have been so. This all before we even touched the trend lines of the broken descending wedge pattern. However, I do not think the situation will continue for too long, as all the moving averages are bunching in close together, and I think this might lead to a cusp of some form. Finally, still overshadowing all of this is January's monthly key reversal down. LME 3-month tin. The most obvious feature in recent days has been the market's drive and break higher over the bearish shift pitchfork for the 2023 action that I drew last week. I did not highlight this pitchfork back then, as I found it suspect, and as I said last week, and I quote, "And whilst I'm happy to retire this pitchfork, I would very much like to see it perform. See if it performs." You see, this upper tine crosses the lower tine of the bigger bullish shift pitchfork by the end of June, so something will have to give way, and perhaps soon, end of quote. There are two things to pick up from this. Firstly, I will retire this unhighlighted pitchfork after this commentary. And secondly, let me explain by what I mean, and I quote, "the lower tine of the bigger bullish shift pitchfork," end of quote. Well, this relates, as you can see on my daily chart, to the late October 2022 to mid-March 23 bullish shift pitchfork, which is highlighted in dark blue on my daily chart. I drew this back at the end of April and going into May, and it still gives the main bullish angle of attack of this market. We're at the moment in between the lower tine below, currently at 24,120, and the middle tine above, currently at 30,445. It's at this point that I'd like to draw your attention to the moving averages. They have been affecting the operations daily and will seemingly continue to do so. I first draw your attention to the long moving average, currently at 23,985. You see, below the market, we have a series of stratified supports that slowed and eventually halted the market's attempts lower. The significant ones were and still are at the following levels: the 2013 high at 25,250, then between 23,000 to 24,155, then at 21,360, and between lower down the 24,435 to 25,10 area. Into these, back in late March, entered the flatlining long moving average to reinforce them, which it has done admirably. On top of that, the lower time has been traversing these supports, and last week crossed over the long moving average, thus reinforcing the support even more. Meanwhile, on top, we have the 2012 high at 25,875, which has been interfering with recent moves higher, assisted by the ever so slowly dipping medium moving average, currently 25,915. Now, these two have been breached, but as yet not broken, though it is a close run thing at the moment. So if you're looking higher, we have lesser Fibonacci lines at 26,825 and 27,330, but the next real resistance is up at the July 2011 high at 29,005. Even then, that July 2011 high is not that strong a resistance, and you would have to look higher past the lesser Fibonacci line at 30,205 and towards the interesting 50% Fibonacci line of the March 2020 to March 22 move at 31,845. So overall, the market has moved upwards in between the middle time overhead and the lower time below of the big bullish shift pitchfork. However, the action since January and its general shape prompted me 3 weeks ago to ask a simple question. Is the action since the height of January a possible, very large bearish halfway hesitation in the making? It is still too early to say for sure. Plus, as I've already said, we have a lot of congestion both below and above the market. But it is still an idea, and an idea that is still alive.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.